Had an email from a listener called Chris, you know who you are, and the subject line of the email was, "Are you right? I beg to differ." And that got my attention, I can tell you. He was calling me out about something that I said in episode 4 of season 15 of the podcast. So, well, roll the titles, I'll tell you in a minute. So in that episode, I was talking about the 40,000 foot perspective, a high level perspective on your financial goals and on markets and things like that. And specifically on the piece that Chris called me out on, I was talking about stock market performance and how if you look at it on a very narrow window, volatility can be truly frightening. But if you sort of zoom out and look at a much wider perspective, even what feel like big dips in markets really, in the context of decades, are just fairly minor blips along the way. Now, while what I said was true, I don't think I said it quite clear enough. So let's just clear things up a little bit. Put 5 minutes on the clock down here. Say a quick thank you to my friends at 7 Investment Management for continuing to sponsor the show. And we'll crack on. So in my comments in that podcast episode, I used the FTSE 100 as an example. So let's stick with that example for now. And I was making the point that over the last year or so, the FTSE 100 had been largely flat, but it had been very volatile in the meantime. So it had been up and it had been down, but it had ended the year roughly where it started. But of course, a year is a very narrow timescale. So what I said was that if you look back over 20 years, even having taken account the tech market crash and the financial crisis and all that sort of stuff, the trend is generally up. Now, actually, though, when you look at the 20-year value of the FTSE 100, it actually hasn't moved very much at all in 20 years, as you can see. So we need to remind ourselves what an index actually is. It's merely a representation of the combined market value of all the companies in that index. Now, by market value, it means the price that the market has put on the shares of each of those companies. And as we know, market prices are driven by supply and demand primarily, as well as the fundamentals of the underlying companies. Crucially though, it doesn't take into account the income produced by those companies in the form of dividends. And that's what most investors would do. They would reinvest those dividends, buying more shares in the companies in the index as those dividends are produced. And that makes a massive difference. And you can see on the screen now the difference between the capital only value of the index, which has gone up about 15% over the last 20 years to the day before I'm recording this video. Whereas if you throw in the income and reinvest that income, that's 135% return. A massive difference. So income is really, really important. And I think that's what was in my mind when I made those comments in the podcast episode, but it wasn't clear enough, so thanks, Chris, for pointing it out. I actually take great pride in the fact that people are willing to point out errors. It means that you care, and I appreciate that. But let's just reinforce this point about perspective, and I just want to zoom in, particularly on the chart, which includes the income being reinvested. So if we zoom in on this particular period, which is between about October 2007 and March 2009, which is the sort of worst period, really, in the credit crisis. Well, that is a decline of about 40%, just over 40% actually, and that's scary stuff by any measure. Worth mentioning, however, remember this is just FTSE 100 shares, and if you'd been invested in a multi-asset approach, holding different kinds of things, you wouldn't have seen declines quite this sharp. So that's a really scary short-term view. But if we zoom out again, and we see that pretty grim period in the context of the last 20 years, we can see just how short-term it was, really. It's probably a bit flippant to call it a blip, but it's certainly just a temporary decline in what is a relentless advance, a relentless upward trend over time. And if we go out even longer, back to 1986, well, the effect then is even more pronounced. And that's why we say that investing is, or should be, a long-term game. Even in that, hopefully, once in a generation financial crisis, the market recovered in just over 3 years, and even that's a longer time frame than markets would normally take to recover. So there we go. Perspective is really important, and so is the reinvestment of income. So questions, comments, as usual, leave them in the comments section underneath the video here. Hit subscribe to the channel if you haven't already. Hit the like button, and don't forget to click the little bell so that you get a notification whenever we put up a new video. So thanks for watching. Have a great weekend, and I'll see you next time.